Okay, so I'm just going to quickly look ahead to 2025 and give you our thoughts on valuations. I'm going to start by just going through how we think about valuations. For those that have joined our quarterly webinars or seen our reports, you'll have sort of seen how we think about it. So there's lots of ingredients that are drivers of valuation. Starts with, frankly, global M&A activity. That's obviously linked to what happens in day-to-day e-commerce world. Second is e-commerce trends. How are they faring? Public market comps, obviously key. Which are trading at 1.5 times revenue today. E-commerce M&A activity clearly been tough. Hopefully, it gets better this year. Brand metrics. How are brands themselves doing? That's obviously more under the control of an entrepreneur or an aggregator. And then deal dynamics. Does a seller have to sell? Does a buyer have to buy, etc.? That all leads to valuation. That's how we think about it. So if we go back to December 2021, that was the high. We've discussed that a few times today. We gave that effectively 60 out of 60 or 100 out of 100 across all those drivers. So loads of M&A, e-commerce was rocking, public market comps were doing great. There was a hell of a lot of M&A. Brands were doing great, and there was a propensity for buyers to spend the 15 billion raised across the 100 aggregators, right? So that led to some of the FBA brands being priced as high as 7 times, which is huge, and obviously some DTC-led brands being priced well into the teens. If there's a recurring revenue element, it could have been nearly high teens, etc. So that was December 2021, the high. Let's fast forward a bit to the low, July 2024. Several months ago, we think that's roughly the low, somewhere last year. We scored a 19 out of 60, right? So M&A activity was, down significantly on a 10-year view. E-commerce trends were tough. Comps were really low. Very little M&A going on in our world. Brand metrics were tough. Deal dynamics, buyers weren't really looking to do deals, and a lot of sellers were still had unrealistic expectations, certainly in 23, got better in 2024. October 2024, it's become more recent. Thankfully, we were waiting for the Fed to reduce rates. There's a serious correlation between interest rates and valuation. So finally, that came later than we thought in October of 2024. So we at our last webinar, which we hosted that month, we increased our scoring to 29 out of 60, so marginally more favorable for deals, and great to see some deals getting done in the last few months. So where are we today? Just before I jump into our scoring, I just wanted to show you this slide. DrivePoint speaks on all of our webinars. They do a great index, a DTC index, an e-commerce index, about 130 listed e-commerce stocks, and it's the best barometer we can find on where e-commerce is trading publicly. So there's been a significant increase in the last few months on EV to sales, going from sort of one for what's that, 1.5 now. So it's had a good run in the last few months. Conversely, EV EBITDA has come down, but it's still high. 8.7 times is still pretty good going. So where does that leave us? This is an old slide. We were looking to title this, apologies. We were going to call it Trump's time, but we thought that was a bit political. So we've just called it renewed optimism. That there is better hope. I've been doing M&A and corporate finance for 25 years, and it always comes in cycles. People are going to have to spend money. Interest rates are coming down. Cost of credit is cheaper. More deals will get done, even in the e-commerce sector. So our scoring today is 32 out of 60, a very small marginal uptick on October of just 3 points. We think today that growing and profitable FBA-led brands can price between 2 and 4x. There's absolutely exceptions to the downside, but there are also some exceptions to the upside. I spoke to one aggregator today who's offered 4.25x upfront and a 2x earnout. So there are exceptions, and hopefully Sleep Socket will be in the exception category there. On the DTC side, majority of DTC-led brands that are growing and profitable. The range is unhelpfully wide because there's such a wide variety, as I'm sure you all know. We're saying sort of 3 times to 9 times. If you have recurring revenue, clearly, that's a game changer from a valuation perspective, but that's broadly what we're seeing. Again, there's exceptions to the downside and the upside, but we try to at least come up with a common denominator. So renewed optimism is how I'm certainly looking at this year, and hopefully hopefully you'll all agree we'll get to 4.5 or 5 out of 10 as our final score.